What up, Hyperchange? Welcome to another episode. Today I wanted to break down why I think Amazon is actually a financial arbitrage machine. And they have created an entirely new business model which gives them a structural advantage and is the reason why they are dominating market share and why the value of their firm is now $690 billion, making them one of the world's largest companies despite the fact that they've never produced a substantial profit. This is an absurd phenomenon. We've never seen anything like it. It is an entirely new way to run a public corporation. Jeff Bezos has convinced his shareholders to value growth over profitability. This has allowed the company to invest every single dollar of profit that they would have made back into getting the business bigger, to making it easier for customers with faster shipping or lower prices. And this has resulted in Amazon absolutely dominating in market share, continuing to grow its revenue at 25 to 30% nonstop, and is a structural reason I think they're going to put so many retailers out of business. Walmart, Target, Costco. These are the three companies we're going to be talking about as Amazon's most similar e-commerce and physical retail competitors. Now, what's so interesting about these firms is they've all been around for a very long time, and they have a history of producing positive earnings and paying out a fraction of those positive earnings in the form of a dividend to their shareholders. And this is great for their shareholders. They get cash in their pocket, but this is also these companies' Achilles heel. Money leaks out of their system every single quarter. There is no money leaking out of Amazon's system. They're, instead of paying you that money to shareholders as a form of a dividend, they're literally putting that dividend back into their business and turning it into lower prices for consumers, which is allowing them a mega structural competitive advantage. Let me put this into a hard example for you guys in the form of avocados. If you'll notice, after Amazon bought Whole Foods, they lowered the prices on all of these key staple items that really get you into the store. Hass avocados, salmon, steak, and things like that. Now, the reason why Amazon can do this is because prior to getting acquired by them, Whole Foods was one of the most profitable grocery chains out there. Now, Amazon can acquire them and immediately bring their profit margins to 0%. And although the profit margins in the grocery industry are only about 5% on average, taking those margins from 5 to 0% can make a huge difference in terms of the prices to consumers. If you think about all the costs that a grocery store has, rent, paying employees, all the infrastructure, all the stocking, there's just so many costs that aren't actually the food that Amazon can plow those 500 basis points of margin directly into creating lower prices. I'm in Manhattan, Union Square, Whole Foods. That's where I go to check out what's happening, and they are selling Hass avocados, 4 Hass avocados for $5, $1.25 per avocado. This is absurd. This undercuts every single grocery store out there. It's literally why I go to Whole Foods, because I love avocados, and then that gets me to buy more stuff. But this is an incredible structural advantage, because if you're Walmart or Costco, you're selling the exact same products that Amazon is, but literally for a higher price, because you're forced to factor in the dividend that you need to pay for shareholders. Just to give you guys a stat to put this in perspective, Amazon's EBIT in all of 2016 was $4.1 billion. But $3.1 billion of that came from Amazon Web Services. So in fact, Amazon is subsidizing itself not only with this zero profit model, but with all of the profits from its cloud computing service, AWS, and using those to plow more money into its loss-leading retail operation to continue to dominate in market share. Walmart, for instance, paid out $6.2 billion worth of dividends in 2016 alone. Walmart paid out 6 times as much profit as Amazon's retail business did, just in the form of dividends to shareholders, and this is crippling them, and this is why it's going to be so hard for them to compete with Amazon. And what's fascinating is this trend is diverging. In fact, in recent quarters, Amazon's retail business has actually been losing money, but AWS has been making so much money that it's making it look like the company as a whole is break even. So I don't know when this stops, because now Amazon is so big, eventually they have to be able to make some money and return some value to shareholders. They can't just continue to grow at 25 or 30% forever. Or maybe they can. I don't know. Will they ever get valued on earnings like a traditional firm? Will this just be a new paradigm where Amazon's growing forever and they always get valued on that growth? It kind of makes no sense to me. Now we're in this crazy moment where Amazon has figured out this frictionless business model and no one that they're competing with has. And I think this is the exact reason that they're going to dominate across the entire retail sector. And sure, Amazon Go and their technology where you don't have to wait in line is a huge game changer, and that is going to even accelerate the pace of their disruption, but the fact that they can sell you an avocado for 20 or 30% cheaper than anyone else and still be making de facto the same margin because they don't have to pay out that dividend is an incredible, mind-boggling concept we have never seen. It is being implemented at an absurdly huge scale. Maybe this is a consequence of being in a zero interest rate environment for how long we have been, and there's so much free money flowing around the system that this is just a consequence of that. To sum it up, all of Amazon's competitors are crippled by the fact that they need to pay out dividends consistently and show their shareholders profit. Amazon does not have this. This is a structural financial arbitrage, which is why I call Amazon the financial arbitrage machine, because they have figured out a business model that is inherently more streamlined and just by definition concretely more efficient than anyone else in their entire sector. I can't see them losing unless another company comes along and is able to convince its shareholders of a similar strategy. Anyway, this is Hyperchange. I would love to know what you guys think in the comment. Amazon, the financial arbitrage machine. See you guys next time. Peace.